Welcome back to another episode. I'm your host, Ryan Richards, a residential loan officer and real estate investor based out of Massachusetts and Rhode Island. Today I'm bringing another solo episode talking about 3 things you can do to quote-unquote hack your mortgage. 3 tips, tricks, strategies that you can use to optimize how effectively you pay back your mortgage and stay on top of opportunities. So if you're interested in learning how you can save on your mortgage, and here's some of the things that loan officers don't always share with you, stay tuned for this episode and enjoy the show. So here are 3 things that you can do today to try to save as much money as possible while having your mortgage and be as proactive as possible when it comes to managing your debt. Some of these things loan officers don't always share with you, and I'll break down some of the reasons why. But these few tips and tricks can save you hundreds of thousands of dollars if you do them correctly and you implement them appropriately. Number 1, which you've probably heard this concept, but make an additional principal payment on your loan every year. And you don't have to do it in one lump sum. You can actually just figure out what that calculation would be to pay one extra payment every year and add that on top of your monthly payment. And a lot of servicers allow you to actually automate this step. You can include an automatic additional principal contribution with every payment so you don't have to think about it. And I highly recommend doing that because that's one of the flaws that people find themselves in. They have the intention of paying that extra payment, but they never actually do when the time comes each and every month. But I want to show you what the savings look like on that example to show you how impactful just this simple trick can be. So if you were to borrow $400,000 at just say a rate of 6.5%, your monthly mortgage payment comes out to about $2,500 a month. So if you were to make an extra principal payment every year on that loan, you would have to pay an additional $2,500 a year towards your mortgage, which obviously that can be a fairly simple calculation to figure out how much more do I have to pay each month, which in this case, thankfully, it's an extra $200 a month. So if you pay an extra $200 a month towards your mortgage, that shortens your mortgage term from 30 years down to about 24. So you take 6 years off of your mortgage, which when you calculate that interest savings by paying it off 6 years sooner, that saves you over $110,000 in interest just by paying an extra $200 a month. So don't miss this simple trick. Many people do, and if you intend to hold the home for a long period of time, like 20 or 30 years, this makes a lot of sense. Where it doesn't really impact things is if you only plan to hold the home for 3, 4, 5 years. In that case, it really doesn't make a big difference whether or not you apply that extra principal or not. Of course, there will be some savings, but it will not be as significant as, of course, $100,000, which is extrapolated over that 24-year time frame. So something to keep in mind, if you plan to hold your home for a long time, live in it for a long time, make sure you make that extra principal payment. The second thing you can do, which this is one that mortgage lenders don't always tell you, if you took out a loan that has mortgage insurance, depending on the loan product, some loan products this does not apply for, but if you took out a conventional mortgage, you might have the option to remove the mortgage insurance without refinancing. Now, lenders don't tell you this because lenders don't make money off of removing mortgage insurance. They make money off of refinances. So a lot of lenders don't advise or don't recommend this type of strategy because it's not profitable for the company. But I'm here to tell you it's definitely something you should do or look into. How it works is essentially, let's say you bought a house in 2020 with a 10% down payment. More likely than not, you have mortgage insurance as well on top of your monthly payment. But since 2020, obviously values have increased quite a bit. But what's also true is if you took out a mortgage in 2020, chances are your interest rate is very low. So for you to refinance to remove that mortgage insurance, it doesn't make sense because you're going to take your 2 or 3% rate, bring it up to 6% to save a few dollars on the mortgage insurance. It doesn't make any sense. But if you have enough equity, say you have 20% equity, which if you bought a house in 2020, chances are you probably do, you can actually reach out to your servicer and request to have your mortgage insurance removed. Typically there's a small administrative fee. A lot of times they'll require an appraisal on the property, but you can request to have the mortgage insurance removed without having to refinance. So you don't have to touch your interest rate, you don't have to spend potentially thousands of dollars to refinance. You can request it to be removed. So that's one trick. If you're in a position where you bought a house a few years ago, you feel like you have a lot of equity, it doesn't make sense for you to refinance, but you want to get rid of that mortgage insurance, reach out to your servicer. Not every loan product allows this feature, but definitely worth asking the question. And if you have questions about your specific scenario, obviously I'm happy to take a look at it and give you some thoughts and advice. The third and final way that you can be very proactive and efficient with managing your debt is having a preemptive and proactive conversation with your mortgage lender about when would it make sense for you to refinance. Not necessarily what month or what year, but at what interest rate would it make sense for you to refinance. And actually go over the numbers now ahead of time. Because what ends up happening is mortgage rates in today's market take large swings. So if you just wait in hopes that one day you're going to stumble across the right news article that prompts you to refinance, you might be too late. That rate might have been there last week, it became yesterday's news, and that rate's gone. So you want to make sure you're proactive and have the conversation now so you can go over the numbers, digest the thought, quantify the return on that investment so that when that opportunity does arise, you're ready to jump on it and you don't miss out on opportunities. And you might think when I'm saying this, I'm pressuring people to proactively call their mortgage lender. I'm sure all of you want to call your mortgage lender, but that's not the point. I've seen it many times in the past few years. Look back to October of last year, rates dropped almost a full % in a month, but they only stayed there for 2 days and rates jumped right back up. If you look up the national average for mortgage rates during that October timeframe of last year, September, rates dropped to almost 6% nationally. And they shot right back up into the sevens within the next couple days, couple weeks. So the opportunity window was incredibly small. And we actually, myself, I only got 1 or 2 people to actually refinance and capture that rate because by the time they called me, we talked about numbers, I sent them over numbers, we went back and forth. By the time they made up their mind, the rate was gone. So had we had that conversation 6 months earlier, I could have called them and said, hey, John, we've got that rate that we talked about. We can lock it in today. All the same numbers as the last time we talked. Do you want me to lock it in? Yes, done. You already thought about the numbers. You already know the benefits. So just keep that in mind because this market is very volatile and you could miss out on an opportunity by just waiting. So have that conversation with your loan officer. As always, if you want a second opinion or you want some advice on taking a look at things, reach out to me. I'd be happy to dive into your situation and give you some direction. See you on the next one.